All right. Matt, the mortgage guy. In today's video, I'm talking about the Fed meeting, which everyone else is talking about. I'm going to talk about what they said, what they didn't say, how it directly affected mortgage interest rates. You'd be surprised it didn't do what you think it did. Towards the end of the video, stay tuned. I'm going to give you a sneak peek into what's going to happen in 2023 to mortgage interest rates. All right, Matt, the mortgage guy here, NMLS number 1088993. Just some guy on YouTube giving advice on what I see all day, every day, working as a mortgage broker, hundreds of clients, hundreds of real estate agents, conversations being had every single day, what I'm seeing, what I'm hearing, what I'm feeling in the real estate market, and also in the mortgage market. So Fed meeting was a big one. Tons of stir, tons of folks kind of confused by what's going on. So one thing I want to clear up first and foremost, the Fed funds rate, which the Fed has control over, that's the rate that they moved up by 0.75% today. That does not equal mortgage interest rates. I remember going over this in 2020 when the Fed brought that rate down to zero and everyone's like, great, mortgage interest rates are at zero, sign me up. Not the case. The Fed moved that Fed funds rate up 0.75% today. And guess what? Mortgage rates went down. How could it be, right? One of the explanations is in anticipation of this meeting, in anticipation of what the Fed is going to do, the market, which moves every single day in mortgage-backed securities, the 30-year fixed rate mortgage changes every single day, had already priced in, not just this Fed meeting, but probably the next one and the next 5, because they understand what the Fed's objective is and what the Fed is going to do. The Fed is going to push the Fed funds rate up, which is the rate at which banks lend to each other. In turn, that is going to push up all interest rates. Credit card debt, home equity lines of credit, car loans, mortgage loans, right? But that's not a direct correlation where when they meet today and when they make this announcement, mortgage rates go up, right? Mortgage rates went up last Friday. They went up on Monday. On Wednesday, June 15th, the Fed meets and mortgage rates go down, right? What I want to highlight from the press release from the Fed is they've got 2 mandates, and they've made it clear, they did really good this time around, that they're going to do whatever it takes to meet their mandate, regardless of what that does to the stock market, what that does to mortgage rates or the real estate market. They've got a specific mandate. They're literally only concerned about achieving maximum employment and inflation at the rate of 2% over the long run, right? And so when they push up interest rates to slow down inflation, that's all they're like, tunnel vision. That's all they're worried about, right? And so I'll read a little bit of this, and I don't want to get too wordy or too in the weeds on it, right? In support of these goals, the committee decided to raise the target range for the federal funds rate to 1.5 to 1.75% and anticipates that ongoing increases in the target range will be appropriate. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. We talked about that. We knew that, selling mortgage-backed securities off their balance sheet, as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. The committee is strongly committed to returning inflation to its 2% objective. So just a real quick summary, the Fed funds rate, banks lending to each other, was at 0.75%, raised it by 0.75 June 15th, which when this video comes out will be yesterday. So now we're at 1.5%. By the end of the year, that Fed funds rate will be above 3%. I think 3.4% might be the target. So we've still got another 1.5 to 1.75 to go to get into that range, meaning July meeting, another 50 basis points. September meeting, probably another 50 basis points. So the Fed will continue to do this. And obviously they've got like wording on wording on wording and, 17 pages worth of minutes that you may want to look up. It's all online on the fact that they're going to continue to monitor the market, see what happens with employment, see what happens with inflation and all that stuff, right? And so important to the people watching this, what is going to happen with mortgage interest rates? Over the course of 2022, the back half of the year, you can likely expect rates to see a slow increase. But I think if we're at about 6% after, the betterment we saw on June 15th, I wouldn't expect rates to go much higher than 7. And I know that I've gone on record before and said something and then had to reverse course and say, J/K. Here's the cool part is that once the Fed has increased rates, like they took a big swing today, 75 basis points. They're really going hard at inflation. Once they pull inflation down, a lot of people think that they're going to, go hard and fast because they have to push us into a recession. And when that Fed funds rate is up there at 3.25, 3.5, they're going to have ammo to do like they did during, COVID and the lockdown to go back to quantitative easing and lower that Fed funds rate, which will drive interest rates back down. So surprise ending, we are likely to see mortgage rates come down in 2023. What that means for buyers and the good news that I think that it brings is if you go out there and over the next 3 to 6 months, buying a home is easier. Home prices level off. Home prices even go down by 5, 10, who knows, 20%, not likely, but whatever the case, if you qualify for a mortgage at 6% or 6.5% or 7%, and you're able to buy that house, and then interest rates go down to 4% in 2023, you get to refinance and lower that payment by $300 or $400. For some folks that think it's a big disappointment that they only qualify for 380 versus the 425 they thought they qualified for or wanted to buy when rates were slightly lower, it's going to cause you to stay within that 380 budget because rates are high. And so you're going to get that $380,000 house. And then, in my opinion, more than likely be able to refinance it in the future to a lower rate and lower payment. So I think long-term, it might be a good thing that some buyers have this new ceiling placed on them. I don't know, might be a glass half full type way to look at it, but nonetheless, that's how I'm looking at it because when money was super cheap and people were able to qualify for a lot, what they did with that was exactly what we saw. 15, 20, 25 offers. People bidding 50,000, 75,000, 100,000 above ask. And once you buy a house, you can't renegotiate the price. The price is there, right? But on the flip side, if you buy at a lower price, but a higher interest rate, you can refinance and lower that interest rate. So lower price, higher rate is better long-term, higher price and lower rate, right? Because you can't do anything with this price. Once you buy it for 600, it's bought for 600. If you buy it for 540 in the future, you're able to refinance from 6.5% down to 4.5. You're going to win. So that's the glass half full. Let us know if you have any questions at all. If we can help you get pre-approved, let you know what you qualify for, show you scenarios. We'd be more than happy to help. We're in most every state now. I think it's 47 out of 50, but close enough. Reach out to us. Let us know where you're at, how we can help. GreatMortgageBroker.com. Quick little 5-question, 7-question maybe survey just to figure out where you're at, who we need to connect you with to get you started on your home buying journey. Hopefully this was helpful. Thanks for watching. And until next time, we gonna see.